Hello friends, so welcome back to the series on IND AS. Now today we are going to discuss one of the most fundamental and very commonly used IND AS standard, that is IND AS 16, Property, Plant and Equipments, shortly known as PPE, IND AS 16. So if you compare this IND AS 16 with AS 10, again AS 10 is nothing but property, plant and equipment. Okay, I would say 95% of the principles are more or less same, except for few additional requirements or additional alternatives or options which are available in IND AS and is not there in AS 10. Okay, so except for these small changes, 90% it is one and the same. So let's start. Property, plant and equipment. The first point we have to see, what is property, plant and equipment and all. We are not going to have a discussion on this. These are fundamental things and I hope all of you would have been would have learned it in your intermediate or even prior to that. Okay, so we are coming to the recognition and measurement criteria. Recognition and measurement criteria. When to recognize a property, plant or equipment as an asset in the financial statements. The standard says that any property, plant or equipment can be recognized as an asset only when it is probable, that two conditions. One, when it is probable that future economic benefits, okay, we call it as FEB, will flow to the entity, See, future economic benefits will flow to the entity. So this has got two components, right? One is economic benefits. Economic benefits should come to the entity. Okay, only if the economic benefits come to the entity, you can call it as an asset. And what is this economic benefits? It could be in the form of cash, or it could be in the form of some outputs or value addition. It could be anything. So only if it will come to the entity, when it should come. Is it sufficient that the economic benefits have already come in the last day or last month or last year? Okay, so can you recognize that as an asset today? No. You can call something as an asset only if economic benefits will flow to the entity when in future. Okay, so future economic benefits, that is what is very important. Now, that is the first condition. What is the second condition? The second condition is also very important. That is, the cost of the asset can be measured reliably. Okay, the cost can be measured reliably. So I would call these two as the asset recognition criteria. Asset recognition criteria. And if any of these conditions fail, then such asset, even though it is an asset, even though it is beneficial for the company, you can't call it as what? You can call it as a asset in your financial statements, or you can't recognize it as an asset in your financial statements. Now let me give you some examples to understand this. Suppose you take the case of goodwill. Okay, goodwill accounting. You all would have learned when we talk about goodwill, even though it is not something which is covered in IND AS 16, it is something which is covered under intangible assets, we will take it separately. But I am going to give you a general principle over here. Okay, in case of goodwill, you all know that there are two types of goodwills, right? One is self-generated goodwill. Self-generated goodwill. And the second one is what? Purchased goodwill. Purchased goodwill. And you may be knowing that, or you might have heard that this purchased goodwill is something which you have to account in the books of accounts as asset. You recognize this purchased goodwill in your books of accounts. Whereas self-generated goodwill, Self-generated goodwill is a big asset for the company, right? You take the case of Apple. For Apple, its goodwill is the biggest asset. Now that is self-generated. Can you recognize it as an asset? The biggest asset, biggest valued assets in your books. Can you recognize it? The answer is no. The answer is no. Even though self-generated goodwill assumes or is the highest valued asset for your company. And that is the asset based on which you get all the business in the world. You can't recognize it because it fails the second condition. That is, the cost can be measured reliably. In case of self-generated goodwill, you can't recognize it as an asset only because the cost cannot be measured reliably. Okay, so that is the typical example which is generally used to explain the concept of cost measurement. Okay, now similarly I can give you another example. Let's take the case of human resource. Okay, let's take the case of human resource. Okay, HR, human resource. Now when you take a company, a software company or tech company, which is its biggest asset, a company like Infosys, the biggest asset is not the computers, is not the building, is not the furniture it is having. The biggest asset is the human resource it is having, the contract with the employees, okay, the services offered by the employees. Now just think, is it fair to say that the balance sheet of Infosys is true and fair without accounting this human resource? It's a debatable issue. Is it fair to say that the balance sheet is true and fair when it does not consider the human resource? Okay, the answer is yes. It is very important that the human resource asset is to be disclosed, but you can't account it as an asset in the financial statements. Why you can't account it? Because if you remember what we learned in the general definition of an asset. Okay, an asset should be something which is controlled by an entity. Controlled by the entity. Okay, now when you come to human resource, what is that lacking here? What is lacking here is the control. Human resource, the CEO, CTO, CEO, or thousands or lakhs of employees who are employed in the company, they are not controlled by the entity. Since the control is lacking there, you are not permitted to recognize that as an asset in the financial statements. Okay, so now coming back to Ind AS 16. In Ind AS 16, you can recognize an asset as property, plant and equipment only if it meets two criteria. One is the future economic benefits will flow to the entity, and these future economic benefits could be tangible or intangible. It could be tangible benefits, okay, or it could be even intangible benefits. Okay, and the second one, the cost can be measured reliably. I hope that is clear. Okay, so that is the criteria for measurement. Now, having decided to recognize something as a property or plant and equipment, how to recognize? Recognition of PPE. Recognition we have learned, sorry, not recognition, measurement. Measurement of PPE. Having decided to recognize it in the financial statements, you have to, what do you have to do? You have to recognize, you have to measure at what value it has to be recorded of. Okay, that is the second thing. Here also you have two things. One is initial measurement, and the next is subsequent measurement. Initial measurement and subsequent measurement. Now this is the one of the major difference between Ind AS 16 and AS 10. Okay, if you come to Ind AS 16, for initial measurement, the principle is same as AS 10. They say that it has to be initially measured at cost. Okay, it has to be, the initial recognition or initial measurement has to be at cost itself. Okay, and they also give some condition for subsequent recognition of subsequent recognition of cost or subsequent costs are recognized only if the cost can be really measured, and this will add to ഒന്നും കൂടി ഒന്ന് ഈ ഒരു ഇത് എടുക്കുകയാണേ, പറഞ്ഞാൽ മതിയല്ലോ ഇതിൽ. ഓക്കെ. So friends, now we are going to see what is the measurement criteria which are applicable under IND AS 16. Okay, measurement of PPE. Measurement of PPE. Okay, so there are two types of measurement. One is the initial measurement. Initial measurement. What do you mean by initial measurement? When you decide to recognize PPE at the first instance, how it has to be measured, that is initial measurement. Okay, then you have what? Subsequent measurement. Subsequent measurement. Subsequent measurement. Now what do you mean by subsequent measurement? Subsequent measurement means after you recognize the PPE and you measure that PPE and you record it in the books of accounts, thereafter at every reporting date, okay, at every year end or reporting date, you have to remeasure. You have to remeasure the value of that PPE, and that remeasurement of value is what is known as subsequent measurement. Say for example, if a building is recognized as a property, plant or equipment on, let's say, 1st of September 2024, okay, for the financial year 24-25. So on 1st September it is the initial measurement. Okay, now subsequent measurement will be on the year end, and the year end will be on 31st March 2025. This will be the subsequent measurement. Okay, so the principles are different for both initial measurement as well as subsequent measurement. Now here also there is one small key. Okay, initial measurement also talks about two types of cost. One is the initial recognition, initial cost, and you have something called subsequent cost. Subsequent cost. Okay, this subsequent cost and subsequent measurement should not be confused. Subsequent cost is different, subsequent measurement is different. Okay, I will give you an example over here. Suppose let's take the case of a building. Okay, a building was constructed and the construction was completed on, let's say, 1st September 2024. Okay, 1st September 2024 the building is ready. It has got, let's say, 3 floors. Okay, and let's say 6,000 square feet. This is the building, and the construction was completed on 1st of September 2024. So you will have to have the initial measurement. Initial measurement of cost. Initial measurement of cost on what? 1st September 2024. Why do you have the initial measurement of cost on 1st September? Because that is the date on which you recognize the asset. You decided to capitalize, you decided to recognize it as an asset. So this is initial measurement of cost, and the cost of this 6,000 square feet came to, let's say, rupees 150 lakhs. So this is the initial cost. Now what is subsequent measurement? The same asset without any addition or changes, okay, will have to be reported in the financial statements being prepared on 31/3/2025. Also it will appear in the financial statements on 31/3/2026. Thereafter, until this is disposed of or derecognized, it will appear in the every financial statements, and in all these financial statements you will show this building. Okay, building will be measured and it will be shown as an asset. Now this measurement of the value of the building, which is reported in the subsequent financial statements on the reporting dates thereafter, is what is known as subsequent measurement. Subsequent measurement. Okay, now suppose 1st September we had 6,000 square feet, 3 floors. Now let us assume on 1st of March 2025, that is almost 6 months after, 6 months later, they added one more floor, constructed one floor. So it became how much? 3 plus 1. Okay, and the cost of construction was, let's say, rupees 40 lakhs. 40 lakhs. Is it subsequent measurement? No. Subsequent measurement happens only when? Only on the reporting date. And is this a reporting date? No, it is not a reporting date. It is an in-between date. Now what is this? Is it the initial cost? No. Initial cost was 150 lakhs. Then what is this 40 lakhs? This is what is known as subsequent cost. Subsequent cost means those costs which are incurred on the same property or plant or equipment after the initial recognition. You incur expenses after its initial recognition. That is subsequent cost. So subsequent cost is different from subsequent measurement. Okay, now if you see the recognition principles I would say are different for 3 different things. One is initial recognition, initial measurement of cost, okay, and subsequent measurement. Subsequent measurement. Now if you see the initial measurement, the standard says that any property, plant or equipment should be initially recognized or recorded at cost. Recorded at cost. You can record any PPE initially at cost only. You can't use any other model. Cost model, only cost model. Okay, so initial recognition, only cost model. No other method, no other policy permitted. Okay, now whereas subsequent measurement, when you come to subsequent measurement, there is a change. And this is the major difference between your AS10 and IND AS 16. What is that? When it comes to subsequent measurement, the standard gives you 2 alternative options. Okay, 2 options. Option 1. What is option 1? You can go with the same cost model. Cost model itself. So here you recorded at cost, the same model you follow. This is option 1. And here comes the second option. Option 2. IND AS 16 permits you to follow fair value model. Fair value model for what? Subsequent measurement. Subsequent measurement. But don't call this as fair value model. Instead, call it as revaluation model. Okay. So I will change the name from fair value model to, I will change it to what? I will change it to revaluation model. Okay. So revaluation model. So what is the difference between this cost model and revaluation model? See, in the case of cost model, you just continue to recognize or continue to measure it at cost itself. Of course, less depreciation or accumulated impairment or whatever. But the base is cost itself. But when you come to revaluation, what do? You are revaluing the cost at its fair value. Revaluing the cost at its fair value. That is what is known as revaluation model. Okay, so cost model is 1 and revaluation model is 2nd. Revaluation model, is it permitted? It is permitted in IND AS 16, but only for the subsequent measurement, not for the initial measurement. Okay, initial measurement can be done only at cost. I hope that is clear. Now, here, when you talk about initial measurement, I told you there are 2 elements. One is initial recognition and subsequent cost, or initial cost plus subsequent cost. What is subsequent cost? Subsequent cost means a building is constructed. I told you, I gave you an example. A building is constructed. Initially it had only 3 floors. Now you are adding one more flow. Whether that can be added as property of plant and equipment or should you expense it out? That is what subsequent cost talks. Now they say that subsequent cost can be capitalized or can be recognized as a PPE only if two conditions. One, measurement of cost is reliable, or the cost can be measured reliably. The cost can be measured reliably. Okay, cost can be measured reliably. This is one. Second one, by incurring this additional cost, okay, additional economic benefit should flow to the entity. Okay, so subsequent cost will lead to additional flow of future economic benefits. Okay, so you already had some future economic benefits which you assessed when you capitalized, when you made this initial cost recognition. Now from that, if you expect additional future economic benefits to flow to your entity because of the subsequent cost, then that can be recognized as property, plant and equipment. I hope that is clear to you. So this is on initial measurement. Now, what do you mean by the cost of property, plant and equipment? Okay, so they say that costing comprises of, okay, it's basic concept only, nothing great in that. Okay, cost comprises of what? Purchase price. Okay, then import duties, if there is any import duties, it has to be added. Any non-refundable taxes, that also have to be added. So similar to inventory, in AS 2 you have learned about inventory valuation. There also you had the concept of cost. Okay, same way here also you have to consider the purchase price. Then any import duties, it has to be added. Any non-refundable taxes, it has to be added. If there is any refundable taxes, what do you have to do? You have to exclude that. And then any cost directly attributable in bringing the asset to the location and the condition. Okay, that means landed cost. Okay, any cost directly attributable in bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. What is the intended use? Intended use of the PPE. And for bringing the asset to the location and condition, for it to be capable of its intended use. Okay, whatever cost you incur for this, to bring that asset to the location and the condition, for it to be capable of operating in the manner intended by the management, all such cost can be capitalized. You have the property and plant and equipment. Now you bought a machinery. It has to be installed in your factory in Jammu Kashmir. The transportation cost is a huge cost. Can you capitalize it? Yes, you can capitalize. Why? Because that cost is incurred to bring the asset to the location intended for its use. Okay, similarly, you had to package it. You had to, while transporting, you have to pack it. Okay, otherwise there could be damage. You have to take insurance. You have to pack in using some sophisticated materials, which was very costly. Can you capitalize that cost? Yes, you can capitalize, because you need that asset in that condition itself, condition intended by the management. Okay, I hope that is clear. Now, this is the basic principle. I am not getting into the details one by one, but this is the basic principle. Now, there is something called decommissioning liability. What is decommissioning liability? Decommissioning liability. Okay, I will give you an example. Suppose you took a land which has got, let's say, 10 acres of land. And this land was taken on lease, under lease. It was a plain vacant land. You took it on lease. Let's say you took it on lease for 20 years. Okay, and what did you do? On this land you built a factory. Factory was built, And for building this factory, you incurred something around, let's say, 100 crores. You spend 100 crore and you build that factory. Now, of course, this factory and all assets will become what? Property, plant and equipment. Okay, it will become property, plant and equipment. Now, suppose the lease agreement contains a clause for decommissioning the assets which you are constructing after the lease term is over. Once the lease term is over, what you will have to do? You will have to return the land, right? When you return the land, the lease deed prescribes that it has to be returned in the same condition it was before leasing out. So what you will have to do? Whatever you are constructing, it has to be demolished. That factory has to be demolished. The machineries have to be transported from there. Everything have to be removed. That process is what is known as decommissioning. Decommissioning of the asset which you have already constructed. Now, when you decommission such a big asset, you know, which has already, where you have invested 100 crore, after 20 years, you will have a cost. So, cost of decommissioning. Cost of decommissioning. Okay, cost of decommissioning. Let's say after 20 years, to decommission entire factory, you might incur another, let's say, 50 crore. Maybe possible, it is after 20 years. Or let's say another 30 crore you incur. 30 crores have to be spent for decommissioning all this factory after 20 years. Okay, now this is something which you are going to incur after 20 years. Do you have to account this? Do you have to account this? No, because you have not incurred, right? That is our normal principle. But here, IND AS 16 tell you, see, you have already purchased the asset. When you purchase the asset or when you construct the asset, it comes with an obligation for you. Obligation for what? For decommissioning. Maybe that you are going to decommission only after 25 years. But since you have already undertaken that obligation, it constitutes a it constitutes a present obligation. It's a present obligation which will result in what? It will result in outflow of future economic benefits. In future, economic benefits in future. Because in future you'll have to spend how much? 20 crore or 30 crore. Okay, so the standard says if you have any such obligation and that obligation is a present obligation and that present obligation will result in outflow of economic benefits in future, then that has to be determined, okay, and it has to be accounted as a what? Decommissioning liability. Decommissioning liability. So how do you recognize this decommissioning liability? So you have estimated the cost of decommissioning as 30 crore, but this 30 crore is payable after 20 years. So you have to discount it. And let's say the discounted value comes to, let's say, 5 crore. This 5 crore is your decommissioning liability as on today, which you will recognize as a long-term decommissioning liability. So once you recognize a liability, there has to be a corresponding effect, right? Where do you give that corresponding effect? That corresponding effect will be given to the assets. So the entry for this will be, here the cost was how much? The cost was 100 crore. It was 100 crore. So here the entry will be, okay, so factory building debit 5 crore to what? Decommissioning liability 5 crore. So friends, this is what you do when you decommission a particular asset. You have to, whenever you account for a property, plant and equipment, you have to see, is there any condition for decommissioning? If yes, that cost have to be estimated and its present value have to be recognized as decommissioning liability, and also it has to be added to the cost of the asset. Okay, so this is a special point which you all will have to keep in mind. So that is the initial measurement. Now we will come to the subsequent measurement. Okay.